When you think what makes an excellent investor, the most important thing to know is that there is no need for fancy education. So today I'm going to give you easy, actionable steps for the only 3 pillars you need to master. And as you can see, in the first one, I'm going to give you the mindset tricks to be successful in investing. In the second part of the video, I'm going to give you solid tips on how to actually invest. And in the third part, I'm going to give you some neat tricks that I personally used and helped me grow my portfolio much quicker than the average investor and get to around $300,000 in just a couple of years. My name is Rick, your favorite Italian investor and twin of Mano Ginobili. And when I personally started investing, my biggest obstacle at that time was my head, my mindset. The biggest hurdle in investing is that everything you need to do to make money is exactly the opposite of what your instincts tell you. If you were able to do always the opposite of what your guts tell you, you'd be a wonderful investor with a big wallet. That's the honest truth. Let me give you an example. You walk the shopping streets in your hometown and you see a nice jacket that you'd like to buy. And you read the price tag and it says $400. If a week later you walk by again and you find the jacket on sale for $300, you're happy because you'd be paying less. Now, in the stock market, whenever a stock or an ETF drops in price, our first reaction is to believe it's losing value, not that it's becoming cheaper. And when for some reason the price of a stock soars and grows incredibly, our trick brain tells you that it's gaining value and we should buy it. You just need to see how everybody now is buying Bitcoin at $120,000, but nobody wanted to buy 2 years ago when it was worth $20,000. Now, one thing that I always keep in mind while investing is something that I call the trend line principle. Imagine to track the price development of an ETF over time, like an S&P 500 ETF. The line is going to jump up and down like a crazy monkey, but tendentially it's going to go up if the ETF is broad-based on a strong economy like the US. Imagine now a trend line that cuts through the ups and downs following the long-term trend. That line represents quite precisely the real value of the ETF at any given time, if you've taken a long enough time frame. So if you zoom in, you notice that all the times you see a price spike, the ETF is selling way too expensive. Every time you see a price drop, it means you're getting a bargain. This is simple in theory, but if you zoom in at any particular time and you imagine to be there at that moment, when a price drop happens, you don't know what's next. So you're thinking about everything except that the ETF is cheap. You're thinking, for example, that the price could drop more than this. You're thinking that you might be able to sell and buy again when it reaches the bottom. Or you're thinking that you're going to lose all your money. Again, remember that everything your instincts tell you is the opposite of what you should be doing. The only thing you need to be careful of is that all I'm saying is only valid if you invest in broad-based ETFs, not for single companies, because the fact that they grew for 20 years doesn't necessarily mean that they're going to keep growing forever. Look at UPS. It's going down since 2021 and it's not necessarily going to go back up again. Single companies make mistakes, they stop innovating, and 99% of them, after 10, 20, sometimes 50 years, completely disappear. So finding the unicorns is not as easy as you think. After we've got the right mindset, it's time to take action. Because the truth is, you need to take action today. Remember that investing is a game of time. And to show you how important it is to start early, I want to show you a brief video from George Kamel.
So let me show you the power of starting early with investing with this example from Financial Peace University with our friends Jack and Blake. So Jack starts investing at age 21 and invests $2,400 a year for 9 years. Then he stops at 30 years old. So 9 years of investing, total amount contributed, $21,600. His friend Blake starts investing at 30, and he invests $2,400 a year till 67. So he invests for 37 years. The total amount he contributes is $91,200. Now they're both at age 67. Jack's investment has grown to over $2.5 million. Blake's investment has grown to almost $1.5 million. So get this, 9 years made a difference of over $1 million. Blake never caught up, even though he invested for a longer period of time. So the earlier that you start, the more time you'll have and the more your money will grow thanks to the power of compound interest.
So, what do you need to start? First, you define the playing field. Decide what game you're gonna play. Long-term wealth building, dividend income, or aggressive growth. Usually, if you're younger than 30, aggressive growth might be more appropriate because you're ready to take on more risk for more outcome. So, your investment should be more tilted towards the growth sector than the value sector. Growth ETFs are made of companies expected to grow faster than the market. They often reinvest earnings into growth and don't pay many dividends. Value ETFs instead are made of companies that are more mature and pay more dividends to investors instead of focusing on growth. Dividend income is totally okay, but I would suggest you to not focus too much on income at a young age because you're supposed to reinvest it anyway. Second step is to choose a brokerage. Younger people usually go for apps like Robinhood or Webull. Others open an account at Fidelity, Vanguard, or Schwab. In all cases, the process is easy and it's like opening a bank account. In case you're totally new to investing and you want to know exactly how to open the account, I showed 2 examples with Vanguard and with Webull in my complete guide to stock market and ETF investing. This video is over 1 hour long, and if you want a full step-by-step guide on how to invest, this is the perfect video for beginners. Now, most brokerages allow you to open the so-called tax-efficient accounts. And this is something that you absolutely need to do, because if you're going to invest money for your future, for sure you don't want the tax man to take away everything from you. 2 important tax-efficient accounts you need to know are the Roth IRA and the 401k. A Roth IRA is an individual retirement account where you invest after tax money, but this money grows tax-free and can be withdrawn tax-free if you wait until you are 59 years and a half of age. The 401k is a retirement plan offered by employers where you contribute money each pay period, and your employer typically matches up to a certain amount of your contribution. So whatever your employer matches is basically free money you shouldn't miss. After you're done with the accounts, the next step is to decide where to invest. Good ETFs you should know are VOO, the S&P 500 ETF from Vanguard that represents the 500 best and largest companies of the American stock market, VTI that instead represents the whole American stock market, VGT that represents the technology sector that is known for its strong growth, QQQ that represents the best 100 companies of the growth sector, and SCHD, one of the best value ETFs that gives stable dividends every year of around 3.5%. For most people, investing only in VOO or in VTI is the best choice. They represent the whole market, and therefore they include the perfect mix between growth and value companies. Their historical return has been around 10% per year, so by investing $500 per month, you should expect to achieve $1 million portfolio in 29 years. The interesting thing is how you achieve this million. In fact, after 10 years, your portfolio is still going to be only $102,000. But after 10 more years, it already becomes 4 times as big with $379,000. And after 10 more years, it's going to reach $1,130,000. So you can see how the compounding effect of your investment kicks in later on. And that's why a great investor like Charlie Munger has a famous quote that says, "The first $100,000 is a bitch, but you gotta do it. I don't care what you have to do. If it means walking everywhere and not eating anything that wasn't purchased with a coupon, find a way to get your hands on $100,000. After that, you can ease off the gas a little bit." Now, investing in the ETFs that I mentioned before would be more than enough for probably everybody. But if you really want to get your hands dirty and look for other ETFs yourself, how do you do it? Besides, of course, following my channel where I always talk about ETFs both for American and European investors, when you look for an ETF, there are a couple of details that you need to be aware of. The ETF should have a minimum fund size of at least 100 million. Managing less than this value means there is less interest from investors, and this translates into poor liquidity and wide spreads. The total expense ratio, or TER, which is the percentage of your ETF portfolio value that you're going to pay every year as management fee, shouldn't be over 0.3%. Past performance is never going to be a guarantee of future results, but if you want to check the past performance, look at least 10 years. Never invest in ETFs that are too young or that are too specialized or trendy. For example, I would avoid investing in an AI ETF just because AI is cool, or because it's full of potential, or a clean energy ETF only because you believe that the future of renewable is bright. 99% of the time, when you want to invest in something particular because you believe it has a lot of potential, thousands of people before you thought the same thing, and the price is already overvalued and ready for a crash. Now, whatever your strategy and your ETFs are going to be, there is one thing you absolutely need to do: automate your investments. You don't want emotions to decide for you how much you invest every month. So the best strategy is to use the so-called DCA method, or dollar cost averaging method. You invest a fixed amount every month regardless of what the market is doing. This is a quite efficient way of investing because no matter what the ups and downs of the stock markets are, you manage to get exactly the average market return in the long term, and you basically smooth out the peaks and valleys created by market volatility. So you buy more shares when prices are low and fewer when prices are high. Now, there are 2 advanced strategies that I came up with that you can use to tweak your DCA method to your advantage. And here we enter in the realm of the third pillar, optimization. Because now we have the right mindset and we have already started investing. Now it's about getting the best out of the stock market. The first strategy is what I call tactical DCA. In other words, don't just buy every month, buy smart. The basis of tactical DCA is a regular DCA. So in normal times, you invest the same amount every month and it's automated. But there are some moments in stock market cycles where you need to be a little more creative, and market crashes are one of those moments. So when there is a strong market correction or a crash, try to do this. If the market drops 5 to 10% in a week, double your buy. If it drops further 10%, triple your buy. During a market crash, it's time to reduce your expenses as much as possible so that you have more cash to invest. Because the nice thing about market crashes is that the strongest the market goes down, the strongest and quickest it's going to go back up. So you want to invest as much money as possible during these times. Another strategy I came up with, and I often use it in my investments, is what I call the tactical double investment. Let's say that there are two ETFs that you want to invest in and they are really similar. For example, QQQ and VGT, or QQQ and SPMO. And imagine that you want to invest in both of them. Instead of investing in both ETFs every month, you can increase the final return if you do like this. Every month, you check the return of the two ETFs of the last 12 months, and you're going to invest in the one that had the lowest return in the past 12 months. And you just keep investing like this every month. What's going to happen is that in the long term, you're going to invest more in one ETF or the other in the moment in which they're more undervalued, while avoiding investing in them when they're overvalued. Over the long term, the return you're going to achieve will be mathematically higher than if you instead invested in both ETFs every month at the same time. Now, another important step you need to take to maintain a healthy portfolio is to always keep it balanced. The method I use here, and that I always suggest everybody, is the core and satellite approach. This means that we're going to have a main component of the portfolio and some satellite ones. The core part represents a foundation of your investment strategy and must be a broad-based, well-diversified, low-cost index fund or ETF such as VO or VTI. This is going to provide stability, broad market exposure, and long-term growth, and it can go from 40% of your portfolio all the way to 100%. The satellite components are going to be additional positions that are dependent on your risk tolerance, your interests, and your age. Growth ETFs, value ETFs, small or mid-cap, or international. These holdings may perform better or worse than the core position and are basically there for you to gain experience, taste the market, and be in control of what's inside your portfolio based on your preferences. Now, let's say that you set up a portfolio which is strong, stable, and you're investing a certain amount every month. How can you increase the result or speed up the growth? Most people think the best way is to try to take on a lot of risk and invest in a lot of individual stocks. But the truth is that, in general, even expert investing firms rarely manage to achieve an annual return in the long term that is higher than the 10% of the S&P 500. So if any investor is better off by simply investing in an ETF like VOO, how can we achieve financial independence faster, or $1 million faster, or whatever your financial goal is? The best way is to work on something you can control, which is your expenses. If you invest $250 per month and your friend $500, even if you manage to achieve a return of 20% per year or 25% per year, which is impossible, by the way, in the long term, you still wouldn't ever get to the same portfolio as your friend. If you have no idea where to look for saving potential, trim what I call the big three: housing, transportation, and food. Can you downsize your rental or buy a smaller house? Can you reduce car costs or maybe go car-free? Can you cook more at home instead of always eating out or taking food deliveries? There is always a way. To conclude the video, I want to give you an example of a simple portfolio that works for most investors. This is what I call the Rick D'Agostino's Core 4 portfolio. I used to call it Rick Austin's Core 4 portfolio, but now I'm using my real family name, D'Agostino, in the hope it's not too hard for people to remember. So, this portfolio is going to be made of 4 ETFs with percentages 40%, 20%, 20%, 20%. The core position is going to be VOO with 40%, the S&P 500 ETF. And if instead you invest from Europe, you can look for the same ETF that is also called Vanguard S&P 500 ETF, and the ticker is VUAA. In position number 2, with 20%, we're going to cover the international stock market with VXUS, the Vanguard Total International Stock ETF. Position number 3 and 4, with 20% each, are going to be a growth ETF and a value ETF. Obviously, since we are already investing in the S&P 500 in our core position, these two ETFs are going to have some holdings in common with it, so there's going to be some overlapping. But having these two positions, a growth and a value ETF, allows you to choose in which part of the market you want to have more weight, the growth sector or the value sector. So feel free to give more weight to one or the other if you're an experienced investor. For the growth sector, I suggest QQQM, the Invesco Nasdaq 100 ETF, which gives you access to the best 100 growth companies series of the Nasdaq 100. For the last position, the value ETF, you can get VAG, the Vanguard Dividend Appreciation ETF. Now, if I just didn't talk bullshit in the last 15 minutes and you appreciated what I did, it would be great if you could support my channel with a like and by subscribing to it. You can check my last video here, or maybe this one, where I share the secret to building an ETF portfolio that prints money. Apart from this, I wish you a great day, everyone, and as always, I'll see you in the next video. Ciao!